We literally are having internal meetings like, I hope, pray, like Anthropic and ChatGPT, like start buying Bitcoin, copy our strategy. It's all open source. So you realize actually how strong of a position you are in when every other company that hasn't invested in scarcity has to be deeply concerned about AI ripping them off. And our risk in that is effectively zero, that it's not replicatable, or even if someone tried to replicate it, it would be to our benefit. It's a very unique position to be in. And so I actually think the AI, I would say maybe partially driven bear market, that capital rotation into AI stocks just doing so well, is ultimately something that's very bullish for what we're doing.
All right. Hey, everybody. Tyler Rowe here with the Bitcoin Treasuries.net podcast. Back on the show today is Matt Cole, the CEO of Strive. That's ticker ASST for those of you paying attention. He probably needs no introduction to our audience. You know him well. Since we talked last November, Strive went and basically tripled the amount of Bitcoin on their balance sheet. They're closing in on 20,000 Bitcoin. That's a top 7 position among public Bitcoin holders. Matt, you did that while Bitcoin fell close to 50%. So I'd say the digital credit engine is running full steam ahead. And welcome back to the show.
Yeah, thanks for having me on. It feels like, it's like you said, it's been about a little over 6 months, but Bitcoin is dog years, so that's probably, it feels like it's been 6 years.
It absolutely does, Matt. Like I said, you guys have tripled the Bitcoin you've held since November, and you did it while Bitcoin fell close to 50% here, looking at the current price. So the whole market probably assumed that capital windows were going to slam shut in a drawdown like this. I certainly did, looking historically at the amount of capital strategy had raised in the last Bitcoin bear market. I think we were all kind of, tightening the buckle and expecting not to see a lot of accumulation. But you guys have been a little bit different. Strategy's been able to accumulate. Strive's been able to accumulate. What do you credit to that, and why?
It's a combination of a couple different things. One of them is that this bear market in Bitcoin has been unique in the sense that I believe it's the only one where broader liquidity conditions were not also worsening during the Bitcoin bear market. And so, when we model bear markets, obviously everyone's different, but our assumption is that liquidity conditions become constrained, and that not that you have to fully ride it out, but that you're going to kind of have to ride it out. And obviously for us, but I think more importantly for the sector, that, because of namely strategy, but strategy and Strive and Metaplanet, that the Bitcoin Treasury companies as a whole have been buying Bitcoin way more than there's been selling. And so if you look at kind of the median, not the mean, the median has probably been on average some net selling from some of the smaller holders. And I think part of the reason is some of their debt restrictions are more restrictive, requiring encumbering Bitcoin. And that's caused, people to have to be a seller of some Bitcoin. You've had a few of the smaller players that I think just didn't have deep conviction, that have kind of exited the Bitcoin strategy, probably thought that if you put Bitcoin on the balance sheet that you'll get a premium just by having it and you don't have to do anything else. And I think that thesis never made sense, right? It was actually making the Bitcoin productive in a corporate wrapper that actually drives value here. And I think to your point that so far the first and biggest obvious driver of productive capital and value has been digital credit. That has obviously been one of the quickest growing financial products ever by stretch and SATA. And even as we're talking in this period of stretch, or period of stress, not stress, stretch, that we still have had about $10 billion of demand in 1 year into a new product. And if you just think about that, that is showing that this product, digital credit, is hitting a buyer base that we haven't seen before.
It's official. The Bitcoin Treasuries conference lineup just dropped. Grant Cardone, Adam Back, Eric Weiss, the man who introduced Semler to Bitcoin in the first place. Plus, the CEO is actually running the treasury companies, and the macro voices calling out where the institutional capital goes next. 10 confirmed speakers, 1 closed-door room, September 28th in New York at 2nd. Save 10% on tickets today by using the code SECOND. Reserve your seat by scanning the QR code on the screen or visit bitcointreasuries.net/conference. We'll see you in New York.
That buyer base, I think, comes down to the simple fact that income investing is broken. And we talk about this a lot, but when you have an entire asset class that makes up on average 40% of people's portfolio, right? The 60-40 portfolio. If 40% of the portfolio is broken, then you have this structural bid for something else. That something else could be, moving from income to a hard asset like Bitcoin or like gold. It could be digital credit. It could be other types of products and innovations that just, and I think it's part of the reason why you've even seen demand for bad products like private credit. I'm not a fan of private credit, but why has there been a push there? Because ever since COVID, the returns of U.S. Treasuries have been negative. U.S. Treasuries are thought of as the risk-free rate, and you've had basically an entire market cycle where those returns have been negative, and that structural breaking of income of the 60-40 portfolio provides a massive opportunity for something like digital credit. And I know you know this, but the average buyer of digital credit, I've never met someone that said I sold Bitcoin to buy SATA or to buy Stretch. That's not where this money is coming from. And it's why I'm so convicted that even with this recent bout of volatility, this is still a $1 trillion plus asset class. Even if you said every year this thing's going to have bouts of 20% plus corrections, just having a double-digit yielding product where the issuer is trying to reduce volatility with the balance sheet that these companies have, that is a product that doesn't exist. And if you can also truly minimize volatility, then it goes from 1 trillion to 10 or 100 trillion. So the opportunity here is massive.
Yeah, I think it is massive. And I've got to ask you, Matt, we'll talk a lot about digital credit here today. When did you know that SATA was was going to be the success it has been? I mean, I know you guys upsized your raise when you guys launched the product. You've obviously had a lot of iterations on, I guess, your whole corporate structure as a whole over the past year and since you completed your merger last fall. But it's got to be heartwarming, I guess, to see the amount of capital that's come in during this Bitcoin bear market. Like we were all kind of like wondering, analyzing the space, it was less certain that STRC was this, fantastic product last summer when it launched, but it became very clear, especially this year, that there's just so much capital that wants to buy this. Like you said, it's not people who are rotating out of Bitcoin necessarily into an income product backed by a Bitcoin balance sheet. But I guess walk us through the iterations that you've been through. Walk about how you move this product to daily dividends, how the team thinks about improving this product or improving upon it since its IPO to where it is today, and what that kind of looks like in the future.
I was convicted that when we saw Strategy IPO Stretch, that was the best product that was out there, bar none. And so that was last July. And why that's important is it was obviously after a lot of the newer Bitcoin Treasury companies had announced they were going public. A lot of them had raised pipes. We had already raised pipes. A lot of them had already agreed to convertible notes. And as you know, we turned down convertible notes in our pipe that was raised last May. And the reason at the time wasn't because Stretch hadn't IPO'd. We didn't see Stretch. But I think a big part of our success has been keeping optionality open and not accepting bad terms. And so not fully knowing where we're going to go, but saying we're comfortable to be contrarian, we're comfortable to just say no, to keep our options open and to be patient. And that patience, it's not clear when you do something like that, a couple months later, it'll be clear kind of what that path might be, and then, have an execution plan around that. But that's what happened here. All right. We turned down convertible notes and just kept our options open. Then Strategy IPO'd Stretch. And at the time, even I think some of Saylor's public comments were such that, he was starting to recommend people to move towards preferred equity, but to start with the convertible preferred. And I don't think that that was from any like, any negative reason. I think it was just the timing. It's like, look, like this is the path we took. It's working. You should take a similar path. And when we were looking at it, we're like, well, stretch is the best one. We're just going to start there. Right. And so that's what we did when we IPO'd SATA. It was pretty clear to me that the demand was going to be there late summer. We actually got a call from an institutional investor that said, hey, if you did a pref, we would be a large check into the pref. And I can introduce you to another institutional investor that would do similar. And so it was almost like pushed us. I was like, oh, great. Like, okay, like this is good information, right? And so that was really helpful in the process for us.
I want to talk about something that comes up in almost every conversation I have with Treasury executives. They get the Bitcoin thesis, they see the macro case, but then they walk into a board meeting and the first question is, who's holding it? Are they regulated? Are they insured? Can we audit this? That's where BitGo comes in. BitGo is an OCC-regulated national trust bank. That means they operate under the same federal oversight as the institutions your board already trusts. Your assets are held in segregated trust accounts, never commingled. They're secured in 100% cold storage with multi-signature architecture. If you're building a case for Bitcoin on your balance sheet, BitGo is the custody partner that turns a board conversation from why into when. Visit bitgo.com/Bitcoin-treasury to connect with their team.
It's the best kept secret known by every true Bitcoin OG. CoinKite has been building the gold standard in private key security for years, and they just raised the bar again. The Cold Card Q is an absolute powerhouse for serious Bitcoin treasuries. We're talking a full QWERTY keyboard, air gap protections, and it's built for maximum security. The brand new Cold Card MK5, it has a massive Gorilla Glass screen and new NFC functionality for an even more seamless experience. So if your business is large or small, there's a cold card for you. Head to store.coinkite.com and use the code 6BT at checkout for 6% off. Stop cutting corners on your Bitcoin treasury. You wish for it. Bitcoin is finally on sale. And if you're sitting on BTC and want liquidity without dumping your stack, Arch Lending can make it easy. You can get USD or USDC in minutes, and your collateral stays in qualified custody. They never rehypothecate your assets. As your assets move up and down in value, you can scale your credit line instantly or pull the collateral back when the market runs. If you need help, you get real humans 24/7, not bots. This is Arch Lending. Simple tiers, public pricing. You can check them out at archlending.com.
And then, I think when I started to realize that it was going to really be strong, and I mean, obviously SATA's trading really strong right now. I mean, there's been significant stress. It's trading at 97. And I think that there's a couple different reasons for that. I think the obvious that everyone knows is that daily dividends have been a smashing success. But another, I think, big reason in more institutional circles, which I actually think retail should care about this more, is that we put in a few investor protections that institutions understand really well. They were intentional. They were, something that was negotiated that I actually personally wanted to put in there, just given my fixed income credit underwriting past. And the most important one is that Strive, we actually can't lower the interest rate on SATA unless the average monthly VWAP is above $99. And so if you think about that from a credit perspective, that reduces the need to trust Strive as an issuer, right? But to actually say there's a credit protection in here that we can't just lower the rate, even though it's variable, unless it's trading really strongly. Secondarily, another investor protection is that if we were ever to stop paying dividends, the cumulative rate starts to ratchet upwards towards 20% as a penalty towards us. Thirdly, our management, I do believe that incentives drive behavior. If we were to ever miss a dividend obligation, no one gets a bonus. It's completely canceled out. So that is an incentive to pay the dividends. Our primary incentive is to outperform Bitcoin, right? So obviously to take amplification, outperform Bitcoin, but to treat these as like true credit obligations. And I think on the institutional side, the combination of those is, I think, more appreciated than something like BTC rating, which I think is like, I think on the retail side, people focus on BTC rating, but on the institutional side, they're looking at everything. They're reading the 100-page documents and what are the credit protections. And so I think that on the institutional side, daily dividends on the retail side, I think that combination has driven a ton of demand for SATA, where it's trading at 97. And by the way, there's a massive short on SATA as we speak, and it's still trading at 97, right? And so the underpinning demand for our instrument, I think, is massive. I think it'll be trading at par sometime in the relatively near future, and that there's a lot of demand for us to grow it from there.
That's really interesting, and it is interesting to see, the relative gap between the way the market is pricing STRC and SATA. I think that is kind of a proxy. The pricing is a proxy for the credit risk of the instrument, right? What specifically did you learn from, how Michael Saylor and strategy, ramped this product up, and you've touched on a lot of the key points, I think, in that answer, Matt. But I guess when we talked last November, you said, you guys specifically didn't do the converts, like you said, and that SATA might be the only pref you issue for forever, or at least for a long time, potentially, at least for a year, specifically. How much of a discussion is that day-to-day price on SATA, and like, can you use that as a barometer for the overall market credit risk of your product?
I think in a way you can, but these things evolve and they change, and obviously strategy is taking massive steps to increase the credit worthiness of their company, right? I think that I did a podcast with Fong that got released last week, and he was talking about some of the learnings and just appreciating more how much the market cared about not only having a cash reserve for the dividends, but also to have it segmented and protected and not used for other purposes. And so I think that there's been a couple bruises or wounds over there, but I don't think that they're fatal in any way at all. And I fully anticipate Stretch to trade back to par. But I think it's just kind of like a little bit of bad timing, probably a small misstep or two that shook confidence there. And then, I think one of the realities is that, when you go down so low, you probably have a few people that are looking to get out as it starts to recover. And I think there was more leverage on Stretch than there was on SATA. And so I think those things kind of just compounded on each other. So I think it's partially true to say that, the market's price is, is a reflection of credit risk. But I think that any month of that is not a long enough time frame to say that that's actually the case versus just a market dislocation. But I think what's becoming more clear is, when we first IPO'd SATA, we obviously have a tiny balance sheet versus strategy, right? We're not competitors with them. Like, if you have 20,000 Bitcoin versus 800,000 Bitcoin, they buy more Bitcoin than we have in any given quarter, right? Like, market sentiment of SATA versus Stretch, like, SATA can't pull down Stretch. We're not big enough to do that. And if we are, it's kind of like, it's almost equivalent to like if strategy could take down Bitcoin because they own 5% of Bitcoin. It's like, well, first off, a 5% owner can't take down a network. And in Bitcoin, ownership matters even less than in a corporate wrapper ownership. So I think that fear is overstated, but I do think that you're seeing that the comfort in the credit risk of Strive specifically has been improving dramatically, both because of those protections and kind of understanding those protections, but also because of moving more frequently in dividends, which obviously reduces volatility. And then the simplistic capital structure that we don't have any debt. We only have one pref. There's a chance maybe we do another one in the future, but that's so dynamic. It'll depend on if we even have the capacity to issue another pref. But I will say that there's definitely investor demand for another pref from Strive. Like 100% there is. That would have more volatility than something like SATA would be. There's a lot of demand for that, but whether we need it, whether it's in the best interest of our common and SATA, it would have to meet that for that to be true. I would say if you were to just take the current snapshot of the company, where we're north of 60% amplified, I don't think we would be in a position today where another pref would make sense. But I think that you could you could see a scenario if Bitcoin's moving up rapidly where maybe we want to increase amplification, that maybe that would make sense. But that'll depend on if SATA is growing rapidly as well, maybe that's also not needed. But it's nice to know, like from an issuer perspective, the demand side is there. So if we had a supply desire, that would be there. But as of now, I think we're good.
Interesting. You brought kind of a buzzword that's really useful to the space in talking about the seasoning of your preferred equity, the digital credit model. Given your past experience managing fixed income portfolios with a pension, you said these products need to be out there. They need to be credit rated. Essentially, the market needs time to digest them, and before bigger money can allocate to something like this and have the conviction to say, okay, this product's been out there, it's had time in the market, it's performing, we're going to allocate our institutional money toward it. I guess I've got so many threads I want to tug on there, Matt, but were the daily dividends a move to help move that seasoning along more quickly, or maybe secondarily as a side effect, in that you're paying dividends every single day? So we've tracked this at bitcointreasuries.net. Strive's made X daily dividend payments, and because you're paying a dividend every day, you're paying more frequently than any company out there on the planet. I mean, most companies pay quarterly dividends if they're paying any dividend at all on their prefs. So is that something that has been on your radar? Obviously, like you said, the product SATA has been a smashing success. Has it seasoned more quickly than you expected? And what's like the long-term 3 to 5 year upside on I guess the addressable market for this product?
On the topic of daily dividends and building a track record, that is a important secondary effect. The primary effect was simply to do everything we can as an issuer to reduce volatility, and realizing that it actually made sense that the dividend event itself was a source of volatility. And so when we're watching that, and you don't really have a take for why that shouldn't be the case, is just it actually should be the case that you get a dividend, there's no interest accrual in preferred equities, that it should drop. Then how do we reduce that? Well, we pay a dividend every business day. That way the dividend itself every day does not become an event. That was the primary factor. But I think to your point on building a track record, how I think about this current time for us, also strategy, even though they're so large, is that every single action that we take in public markets every day is part of that track record. And that doesn't mean it's a good track record or a bad track record. It's just like you are creating over the course of the next few years a history where investors will say, kind of like Bitcoiners, right? Don't trust, verify. Okay, well, what happened? Did the issuer pay the dividend? When there was stress, did the issuer respond with steps to support the instrument, or did they abandon the instrument? Right? How strongly did they address return issues? I think that making small mistakes is not disqualifying, but if someone made a mistake, like, did they address it? Did they change? And then if they, obviously the best would be don't make mistakes, right? But mistakes in and of itself are not disqualifying, but it's just how do you respond to every single one of these things? And so I'm zooming forward, and I know strategy is doing this as well, is zooming forward 3 years, 5 years into the future. And what is that story that you want to be able to tell? And then how do you make that story true, right? And so there's certain things that you can't control. We can't control the price of Bitcoin. That's out of our control. To a certain extent, we can't control the price of our securities, right? Like, I can't control the price of our common equity. I can't control the price of SATA. We can take steps to support it, but we don't fully control that market, right? And so doing the things within our power to develop a strong track record to then point to institutions and capture that data, right? So daily dividends is nice because, as we're developing that track record, Strive will likely, at least when it comes to listed securities on NASDAQ or NYSE, have the longest track record of paying dividends in U.S. capital markets history. That's going to be a strong, and if we don't, it'll be close, right? It'll be a strong track record that we keep paying these dividends, that we, maintained a cash reserve, right? That we didn't just utilize the cash reserve for a reason that institutions would not deem to be worthy of utilizing that cash reserve, right? That we're doing everything we can, and then we can go to them and say, hey, here's how SATA did in the bear market. Here are the steps we took. We IPO'd at a 12-month cash reserve. We increased it to 12 months. We increased the interest rate on it a few times. We paid the dividend every single time. We were buying Bitcoin and increasing our balance sheet strength. You can think about that. Obviously, our annual objective is to drive a Bitcoin yield and meet our obligations. And our Bitcoin yield is off the charts high, but in any given week or any given month, the objective is not necessarily to drive a yield. It's more of a longer term objective, and sometimes supporting the instrument digital credit is the best thing in the short term in our view to drive a long term yield for the company and outperform Bitcoin over the long term, right? But then, so like you saw today, the last couple of weeks, we've had Bitcoin buys that were smaller, but they're still buying Bitcoin. We're a track record. We're out there week in out doing these things, and I view these things as all part of that track record building process. Just like how strategy selling Bitcoin, I actually think for them was an important part of their track record building process. And just to hit on that real quick, because I think this is important, and it's a difference between us and them. That part of their, I would think, like nearer term hope would be to get included in the S&P 500 index and to improve their S&P credit rating, right? Like they are already one of the 500 largest companies. Strive needs like a 15x in our price to be one of the 500 largest companies. And I want us to be, and I think we will be, but our goal right now isn't to be in the S&P index. It's to maximize our returns to be one of those large companies, to be in the index in the future, right? So we don't have those same objectives when it comes to like checking off boxes for S&P that strategy does, right? Because I think their MO is they want to be in the indexes. They probably want to be the largest company in the world. And ours is to be the fastest growing company in the world. And so because of that, we're able to be more of a pure play, just focus on execution day in and day out.
Yeah, I got to ask, what is next for Strive? Last year, you guys issued some projections saying, you want to get to 20,000, 22,000 Bitcoin. You laid out the case for that in some of your documentation on how you'd get there. Well, you're there. You guys have, I think, 19,900 Bitcoin as of recording. What is next? You mentioned, maybe there's demand for a pref down the road. Is it just that execution? Is it day by day grinding and, just making each successive day better than the last, Matt?
It is, and it's to start each day with an open slate, but we explore all sorts of different types of opportunities for the company, and I would say almost every single thing we explore, the answer is no. But the point is that we're doing the work, right? We're not just sitting there, trying to, only issue shares and buy Bitcoin. There's a ton of work that happens behind the scenes. There's a ton of risk modeling. Every single decision that we make has way more intentionality behind it than you might realize or respect, just because that's proprietary internal models to our company, obviously that we're utilizing to make every single decision that we make. But I think a status quo would be, I think that SATA has a lot of room to get massively larger, to go tell the TradFi world. Most people haven't even heard of digital credit or SATA, right? So just going out there on our own, going out there with strategy and educating the masses, right? To say, hey, these products are paying a double-digit yield. They're super interesting. They have return of capital dividend treatment. They make for great income products. And I think just doing that, digital credit could become so much larger than it is today. And that could fuel massive growth for Strive, for strategy. And so I think that in and of itself is enough to maintain amplification, to continue stacking Bitcoin. And then anything else that we do, I want to make sure that it's not a hobby, that it actually would be critical to the success of the company, right? It's like, so we won't do something if we think it's non-material. So I think that's kind of the status quo. I think over the course of the next year or so, doing something to ultimately monetize the Semler operating business, which is still under, our purview. But to make sure that we do that as a fiduciary is something that you'll likely see. So even further simplification of our structure, I think, is the direction that you'll see our company move in, and really just be a pure play structured finance company, and make sure that we obviously can meet our obligations, fuel amplified Bitcoin exposure. And I think we've been operating in a bear market, so I think in a bull market it'll be fun to see what happens. But we don't have a projection on our Bitcoin. I think when we announced the potential for like 20,000, it was around SATA IPO and Semler acquisition, of just laying forth. It wasn't less of a projection. It was just that we kind of viewed it as, this is going to happen, or this kind of like has to happen because of the pieces that are following in place. But our goal is obviously to accretively stack as much Bitcoin as possible. And I think that it's likely to be substantially more than we have right now.
If you're building or managing a Bitcoin treasury, you need institutional infrastructure to match. BitGo is the digital asset backbone trusted by thousands of institutions worldwide, offering regulated custody, OTC trading, financing, and settlement all under one roof. They're now a publicly traded company on the NYSE and hold a federally chartered national bank license from the OCC. For Bitcoin treasury companies, this is the infrastructure layer that matters. Learn more at bitgo.com. CoinKite has been building the gold standard in Bitcoin private key security for years, and they just raised the bar again. The brand new Coldcard MK5 brings a massive Gorilla Glass screen and new NFC functionality for a more seamless experience. The Coldcard Q is an absolute powerhouse for serious Bitcoiners, with a full QWERTY keyboard, air-gapped, and built for maximum security. Whatever your setup, executive, Bitcoiner, Bitcoin Treasury, there's a cold card for you. Head to store.coinkite.com and use code 6BT at checkout for 6% off.
The tip is here, and with it, you might be thinking, is it time for me to borrow against my Bitcoin? Enter Arch Lending. They're building the most transparent borrowing experience in crypto. We're talking industry-leading rates from 8.49% when you borrow against BTC, and you receive USD within minutes. Your assets stay protected with qualified custody. There's no rehypothecation, and verifiable segregated addresses are used always. As your collateral grows, you can unlock more liquidity, adjust your line anytime, and extend your term with a single click. And with 24/7 white glove support, you're never going to feel like you're on your own. Arch Lending, simple terms, public pricing, market leading rates at every size. You can learn more at archlending.com.
One of the biggest questions I get from viewers is, digging a little bit into these Bitcoin treasury metrics, and maybe we won't get super into the nitty gritty necessarily, Matt, unless you'd like to. But, when we talked last November, you mentioned that you guys would be targeting probably a 30 to 50% amplification ratio. Obviously, we're setting your amplification sitting in I think in the low 60s today as a percentage wise. That's largely a function of Bitcoin's price action, through a bear market. But how do you think through, I guess, those like targets, when it comes to leverage or amplification, when it comes to determining what type of dividend runway you have? You guys have 18 months of dividend coverage for SATA, between your USD reserve and your STRC holdings. How does the team, come up with a number that you guys think, the markets will respond favorably to? I've also seen you talk that, people have floated different ideas out there, what the right runway is for that type of thing. And I know you're against building too large of a USD stack, obviously, because that's kind of against the thesis, that, having a 3 or 4 year USD reserve doesn't make sense for you guys, when you're trying to accumulate as much Bitcoin as possible. But how do you think through, I guess, those metrics? Are there any metrics that are new or unique to the Bitcoin treasury space that you find particularly interesting, or is there something internally that you could share with us that you use that the broader community may not be looking at?
Yeah, the more I've dug into this, the answer becomes less simplistic and more nuanced. And I'll discuss it at a high level. I'm happy to go in depth in any of it, but to me, the appropriate level of amplification, it really is a complete case by case basis. And the underwriting here is similar to how I think all structured finance investors come to underwrite structured finance, which means that in structured finance, which is, it's what I used to do, you have to get your hands dirty in the documents. If your hands aren't dirty in the documents, you'll run the risk of applying more of like a broad-based principle across the board when the answers are going to be so unique and distinct for each company of what might make sense. And that, I think the good news on that is that in the world of AI, that type of analysis becomes easier than it's ever been before, right? Like you can upload a few 100-page document and ask for specific credit provisions, right? But it's just like as an example, it's like, is Strive or Strategy more risky? I actually think the answer is it depends. It depends on your viewpoint. I would not say Strive is a stronger credit than Strategy, but I also wouldn't say the reverse. And specifically when it comes into like digital credit and SATA versus Stretch, I think it depends on your underwriting and what you value. And we can talk about those differences and kind of where they lie and what they mean. But I think one of the things that I think Strategy and Strive are both aligned on is that when you have preferred equity only as your amplification source, the amplification can be higher than when it's a mix. If you're only in debt, then the amplification likely should be lower. What is your interest rate? What is your burn? All of these different things factor into that right mix. And so and bringing it back to Strive for a second, obviously, because that's our company, we obviously only have preferred equity. We have no Bitcoin that isn't encumbered. We are, I would say, in the depths of a bear market. Not to say the bottom's in, although I think that's a pretty good possibility, but in the depths of a bear market, whatever range of amplification that you think makes sense, you would want that to be at the high end. Obviously, the price itself moving down moves it up, but you actually would want it to be high because Bitcoin's cheap. On a cyclical basis, it's cheap, right? So you would want more amplification. And so, is it 30%? Is it 50%, 60%, 80%, 100%? I would say that if I was an investor in a company and in the depths of a bear market, that you had a company, let's say that they even had 100% amplification ratio, which obviously means that the preferred equity position is equivalent to the Bitcoin on the balance sheet, right? Like it's the same, which means if the company just shut down tomorrow, there's no Bitcoin for the common equity investor. Well, if you had that structure, you had an 18-month reserve of cash, and Bitcoin is, let's say it was whatever, $50,000. We will not have 100% amplification ratio. I'm just saying, like in a hypothetical scenario, would I want to buy that company? I would probably love to buy that company. I would view that company as like a long dated call option on Bitcoin, almost like a leap on a leap, right? Like if you think about it, because of the structure that's embedded there. And so, I don't, not that we'll ever get there. It's really almost like impossible for us to get there unless Bitcoin really went down. But the point being is that I'm not concerned about our amplification ratio as a metric right now. I think it could go higher. We would feel comfortable with it higher, especially with the cash reserve that's being maintained. But I think the question for us is less of like, Matt, how high would you take amplification? But to say what really matters here is that the SATA investors are comfortable, the ASST investors are comfortable, and we as management are comfortable. Like, right, like all of those things being true is kind of like the right symbolic, or the right flywheel nature for running a Bitcoin treasury company, right? So if one of those pieces are off in a material way, that is an important kind of piece of information to take in to think about how to manage these things. Now, the good news is that all of these investors are very engaged. They listen. They're willing to hear you out and take constructive dialogue. And oftentimes you can educate and kind of come to an agreement upon kind of what makes sense. And so I think why that's important is I think the overall market has become much more comfortable with higher amplification ratios today than maybe they were several months ago, right? And so when I was saying back then, 30 to 50%, I still think 30 to 50% in a non-bear market is probably the right level of amplification ratio. But I think it should go up. You shouldn't want to constrain it from going up in a bear market. I think that would actually cost shareholders a lot of money. So I feel very comfortable with where we are right now. But if you had 60% amplification ratio and you had debt that's due in 6 months, that would probably not be appropriate, right? That'd be a very risky position, but that's not obviously the position we're in.
Yeah, I think that makes a lot of sense. Now, I'd like to, you touched on the Semler deal that happened last fall, that you guys were able to merge with them and acquire them and just get a lot more Bitcoin on your balance sheet, which definitely helped ramp up, scaling your preferred equity and being able to attract, I think, a lot of capital there. How do you think about M&A broadly in the space? I mean, obviously, you want to be judicious on that. In a management team, there's a lot of due diligence involved. There's complexities of the underlying operating business. But I think a lot of us thought perhaps after the Strive Semler deal that, if Bitcoin's price continued its downward trend, we'd see a lot of M&A activity in the Bitcoin Treasury space on companies that are providing amplified Bitcoin exposure. Have you been surprised that there's been little M&A and activity? And how does your company approach thinking about that and just thinking about strategic acquisitions?
I have been a little surprised at the lack of activity broadly. For us, when we started to have takeoff velocity from SATA after the Semler acquisition, future M&A opportunities, the bar became substantially higher. So on one hand, we had a lot more Bitcoin. On the other hand, you had a lot of the Bitcoin treasury companies actually starting to sell Bitcoin. So when you start to go down that list, the amount of Bitcoin that a individual corporation holds starts to dwindle pretty quickly as you scroll down the Bitcoin Treasuries website, right? And so when you own 20,000 Bitcoin, the question becomes, should I pay, a few $1,000,000, to lawyers, to bankers, do a ton of work, potentially be constrained in ATM activity whenever there's MNPI involved, which in M&A, there typically are periods where there's MNPI involved, right? That, to acquire 1,500 Bitcoin as an example, like when you already own 20,000, like we've had weeks where we acquire more than that just through SATA issuance, right? And so it just starts to become something that it's really hard to make sense. Now, obviously, there's a few companies that own a lot more than that, but the question still becomes, in M&A, it's like, is this a win-win transaction for both sides? Are you stronger together? Does it make sense? And usually the answer to that is no. But for us, it's kind of been the calculus. Not to say we would never do M&A again, but just that the bar is substantially higher for us to do so. But I think for some of the other ones, it's hard to launch digital credit. So I could imagine a scenario where two of the medium to smaller players, they're struggling to have the Bitcoin stack to issue digital credit, but if they wanted to, a combination could just say two players that wanted to do it, but were each too small on their own, might be able to do so together. Something like that, I think would make sense, but also, I'm not running those companies, but I think you have some that haven't sold or sold very little that have deep conviction in their own strategies. And to be fair to them, we're in the midst of a Bitcoin bear market, and I wouldn't want to write them off as dead at this point. I think some of them will find their way out of this.
I think a lot of players in the market have seen the success of SATA and definitely want to emulate that. And I have been surprised that they haven't, copied from your playbook, but I'm sure that, there's extenuating circumstances with every company, and every company's decision is different. I think you guys made just had flawless execution with the merger. So that was really exciting to see. And that was one of the big stories that has been so cool to watch in the space is how that came out of a interaction you guys had at the unconference last year in New York. And, we're certainly excited here at BitcoinTreasuries.net. A little shameless plug. We've got the next conference coming up here in New York, the sequel part 2 here, September 28th. But how important was the conversation you had with Eric Semler at that initial unconference into making that merger happen?
I guess I'll drop a little maybe unknown of this, but my conversation there was actually not with Eric Semler. It'll be with an individual that will remain nameless unless they want to go public. But it more kind of lit the idea that then led to a conversation with Eric shortly thereafter, while I was still in New York. But it wasn't initially with him. But I would say that, to me, the biggest value of these kind of industry conferences is getting a substantial amount of the players in one room, in one city at a time to interact with each other, right? Because I still deeply believe that our industry is very unique in the sense that we will be stronger if more of us are winning than crushing each other, right? And so these conferences really are collaborative. They really are looking for ways to help each other win and grow their Bitcoin stacks and find their unique ways to be positive contributors to Bitcoin. And I think that a lot of these different Bitcoin treasury companies do have very unique ways that are different for them than for us, right? And so getting together is very valuable. Sometimes that could result, obviously, in an M&A transaction, right? But even if it could just be a business idea, it could be calling out something that someone's not doing well in a productive conversation, to them, versus like on X in an unproductive way or something like, right? Like there's just so much positivity that can happen there. I consider myself friends with so many people in this industry. So it's important to me, like for us in our event schedule, because like September and October and November are crazy busy months right now. It doesn't feel like it's slow, but summer is generally a slower time in finance and capital markets, historically. But kind of going into that, a lot of what Strive will be doing in this fall will actually be TradFi conferences. Like our schedule is loaded with these things to talk about SATA and kind of go more in depth with them, because they're the more natural buyer of the product. But you combine that with the Bitcoin or the Bitcoin treasury type of conferences and kind of going to the industry, kind of helping each other, aligning, and then going out into I hate to say, like, they're both the real world, but the more TradFi world, right? And orange pilling some of these people. That's kind of the dance, and they're both extremely important, but for very different reasons.
You mentioned, sometimes a lot of conversation happens on X, and sometimes it's very unproductive. There's been some, famous criticism from, I guess, Bitcoiners who are maybe taking an ideological stance against maybe your strategy at Strive, and you've been, warm enough to engage some of that dialogue. Of course, there's some traditional finance criticism as well that I think is, at sometimes it's lazy, where people are calling, the treasury strategy a Ponzi scheme. But I guess, the broader question I have for you is, are there criticisms maybe of your strategy that you have taken to heart? Are there some that, are grounded in something that you've been able to learn from? And what do you make of, I guess, the criticism from the Bitcoin community for people who want to see Bitcoin become, the money for the world, but criticize your strategy of bringing it to public equity markets?
So I think in a lot of ways, there is actually more of a deep alignment than they realize. And part of that's because sometimes people don't engage, and you just, you spout something on X. But when you actually get together with these people, I think what you find is you have more in common than you disagree with. And my view is, I do view the properties of Bitcoin to be such to be perfect money, or the best form of money that we've ever seen. And I contrast that versus just the pragmatic reality that we live in a fiat world today. and that most people can't handle the volatility of Bitcoin. The legal and tax restrictions around Bitcoin make it such that it can't function as money today because the governments are restricting it from being money, right? You can't have a money that every time you pay for a coffee, you have to do a tax transaction. What that results in is one of two decisions, which, maybe some of the Bitcoiners would say, just break the law and don't report your taxes, right? But like the reality is you either break the law, you don't report your taxes, or you have to file a taxable transaction every time you spend your Bitcoin, right? Which just means that it is a very imperfect money today, largely because of it's still emerging as a growth story. It still has a lot of room to grow as in its price just to actually function as money, but also the legal restrictions. And so, my question is like, who's actually going to help do that? And I think Bitcoin Treasury companies are a core part of that in places like DC across the globe. It's why having international Bitcoin Treasury companies is so helpful, that corporations are likely to be drivers of positive regulations around Bitcoin. And so to not just have Coinbase, who obviously has every single cryptocurrency over the sun, being the advocate in DC, but actually have Bitcoin exclusively focused companies in DC advocating for Bitcoin, I think is such a positive thing. And it kind of gets back to digital credit and my view on digital credit. So my view on digital credit is that we live in a fiat world today, and I do think we're transitioning to a Bitcoin future. And I think digital credit is that bridge, right? It's backed by Bitcoin, but pays a very high yield in fiat. And, you take someone that maybe doesn't own Bitcoin and they buy that, and hopefully my view is hopefully over time as they start to see that and they start to see the dividends get paid, that, I think there's always a place to hold it. But maybe for some people they say, why am I getting 13%? Why can this company pay 13%? Oh, they're making a lot more than 13%. Maybe I want to own Bitcoin, or maybe I want to own their common equity, or both of those things, right? That educational journey with something that's less volatile will be an important part of that journey. And so I think, some of the Bitcoiners will see us be good actors, see us actively supporting, contributing to Bitcoin policy, doing similar to Bitcoin development and developers and kind of the open source ecosystem. And I think over time, we're in a bear market. And so at any times in the depths of a bear market, I think, you're going to see everything be at its worst, right? You'll see in digital credit, you're likely to see the credit spread be at its highest. You're likely to see infighting in the community. You cause the bear market, you cause the bear market. And in bull markets, I think we'll all be more friends again. But my view is that, those hardcore Bitcoiners, I don't view them in any way as enemies. I think disagreements are healthy. I think, even someone that might have a permanent view that they don't like the common equity exposure, or they don't like the exposure of digital credit for whatever reason. I can't tell you how many people I'm deep friends with that have very different views on what makes for a good investment than myself. Whether that's, Bitcoin or any of these securities or anything, right? To me, that's just a fun debate. And I think that, where it can go wrong is when you start to assume bad intentions versus just, hey, you underwrite a risk differently than I underwrite it. To me, that's healthy. That should always be the case. And I think some of the deeper infighting, I think, will subside as Bitcoin starts moving up.
Yeah, I think you're right, Matt. And I think most Bitcoiners, most people who view Bitcoin as a superior asset, superior money, agree with your strategy and recognize that you're attacking different capital pools than someone who's just sitting home and hodling Bitcoin with every successive paycheck just DCAing every time. I did want to touch on one more kind of change you made on SATA recently. As it got tested and traded down 10% off of the par that you target around 100. You kind of crowdsource in a fun way some information and made the decision that you guys were going to let SATA's price run over $100 potentially in certain situations. Can you walk me through that and what led to the decision? Was it just reacting to how the market in digital credit was was kind of forming or dislocating around par, and how do you think about that moving forward as a ongoing strategy?
Yeah, we coined it the controlled burn, and obviously the controlled burn of the shorts, and what we were noticing was both in several different areas of data, but the most public and obvious would be short interest and borrowing rates, different types of data around shorts, that there was a pretty abnormally large short position on SATA. And, obviously the price of SATA has been holding up pretty well. And, my view is I don't demonize anyone that takes any investment or capital markets activity. So I don't personally hate shorts, but as someone that's running a company, just thinking about game theory, I'm going to make someone that's going to short our securities make their job as hard as possible, right? And so what would make their job easier is if they know that their downside is SATA trading at 100, right? And so what the point of lifting that was to say, if we always are just basically issuing all the shares that we possibly can at 100, it actually creates an incentive for shorting in the system to build up over time to an unhealthy manner. And I think that right now it is in an unhealthy manner. And, I would be perfectly fine if that short position unwinds largely. You're never gonna have zero shorts, but the large portion of it unwinds and SATA doesn't trade above 100. That's a fine solution for me. But the way we were seeing it is that, we might have to let it trade above 100 because of if you think about the position right now, you have SATA trading whatever, $10 million a day. The volumes are obviously down in the midst of a summer, and you have like a north of $100 million short position out there. Well, think about that unwinding. To me, it's very likely that if it unwound, it would push the position over 100. And so just to say that, we don't want our stocks to be used as like a massive shorting vehicle for whatever purpose that people want. And if we do, you might still make out okay. You might make money, but we're going to make your job hard. And we made that harder by letting it float above 100 if we deem it to be in the best long-term interest of minimizing volatility. And so I wouldn't think about it as, SATA is going to likely trade above 100 for long periods of time, or obviously that's not our goal. Our goal is to have SATA trade at $100 for the maximal extent possible, but to be cognizant of all publicly available market information that, when used, could create risk that it trades off of 100 for longer periods of time. So that was the whole point of the controlled burn, where a controlled burn, the hopeful part of a controlled burn is that you have to burn as little as possible, right? But you're willing to, let it go to, 105, 110, whatever it has to go to if needed, to ultimately reduce the risk of the bigger forest fire, which I think a large short position has the potential to do. So I think the market was overwhelmingly supportive of that. We got so much, not only the public sentiment, but just DMs, emails, so many, both institutional investors and retail investors that were really, really supportive of it. Made me pretty confident that it was the right move for our security. But I would anticipate that this will be, something that will be in place for a minority of, an average year for our companies. Probably several years we won't even have to do it.
Yeah, yeah. The carry cost of that short trade was so high. Not only do you have to pay the dividends, but the borrow rate was just like phenomenal. Is that a function, do you think, of a high retail position on SATA? Because, in order for a stock to have such a high borrow rate, for a sustained period, that means a lot of people aren't lending out their shares. What do you attribute to the high, cost of that short position?
Yeah, I think a lot of people aren't lending out their shares, which, to be fair to them, I actually think there's a lot of merit to not just from a perspective of not wanting people to short the stock, because when you lend them out, the interest actually loses its return of capital dividend treatment, which Ben Workman put a post out last week, but I think a lot of people didn't understand that. And the last thing we want is someone to, lend out their shares and then realize that they created a tax bill for themselves, right? So the economic cost is actually higher, which means that naturally you should have less people that want to lend out their shares for something like SATA than a normal security. So I think that's probably part of it. And then, I think as whoever's the short position is, my guess is it's probably more institutional, just given the size of the position. But when you're paying such a high interest rate, it typically means it's likely to be considered more of a short-term position than a long-term position. Like you wouldn't pay, a 30% annualized borrow rate on top of a 13% dividend for something that you're planning on holding for a long time. And so, I think when you combine all these things, it feels like it's like a short-term thing, but we're prepared to do the controlled burn for quite a while if it was not the case.
One more just little macro question here to close it off. We're up against our time here, Matt. But you mentioned that this is the first real Bitcoin bull market where liquidity has still been quite open. Governments are still spending like crazy. The monetary position is still relatively dovish. There's been some tightening. Compared to other historical periods in the last 10 to 15 years since we went to a zero interest rate type environment. But what does this mean for Bitcoin and Bitcoin's price and downstream of that Bitcoin Treasury companies seeing, there's the S&P is up big. There's a lot of money flowing and rotating into AI and various IPOs. A lot of companies out there are raising debt. So there's a lot of money being invested into credit markets, into equities markets. But Bitcoin, is down 50% from its all-time highs. I guess how do you read that moving forward? Has it updated your conviction in the strategy in any way, or informed the strategy in any way? What's your lay of the land there?
At this point, if Bitcoin is doing what I think it's doing, which is in the bottoming process right now, and my view is AI is going to create a productivity boom cycle that we are still in the early innings of, even though there will be periods of any productivity boom, any call it like bubble, which I think AI at some point is likely to be a bubble. I just don't think we're there yet. That if that's how it plays out and Bitcoin bottoms here down just over 50% from its high and moves up, I would call that actually more like a super cycle environment than its past bear markets where it's gone down 80%. If we end up going down 80%, we'll have to kind of reassess what that means. I don't think it means Bitcoin's dead, but obviously that means a different thesis than what I think still is in play right now. And I think that would be actually incredibly bullish, that Bitcoin had a intra-bull market cycle kind of bear market, like a secular bear market against Bitcoin. And I would say it almost was driven by what I view as kind of like the death of the cryptocurrency sector, right? Where Bitcoin is going to be the winner, but there's really nothing that I can find to be bullish on in the broader crypto ecosystem. And a lot of crypto investors also own Bitcoin. Bitcoin had its IPO moment where IPO investors are taking chips off the table. I think Bitcoin is becoming institutionalized, which means that for some of the OG hardcore libertarian Bitcoiners, it's kind of not becoming what they hoped it would become. So it makes sense why they may not have as much bullish nature, even though it still has its pure, scarcity to it. And then rotations into AI. Like I say all these things, even though it's a lot, is because they all combine into what I think makes sense to have a Bitcoin kind of bear market here. But I think if it ages that this is kind of the bottoming process, then I think that's actually incredibly bullish for Bitcoin. Actually, like almost more bullish that it had this smaller downward scenario, and then it starts to move back up. And you think about this, that we're in this world of abundance with AI. And one of the things that's been kind of going viral lately is, you got to be really careful with what you tell the AI. You don't want to tell it your proprietary information. And we literally are having internal meetings like, I hope, pray, like Anthropic and ChatGPT, like start buying Bitcoin. Like, copy our strategy. It's all open source. Like, and so you realize actually how strong of a position you are in when every other company that hasn't invested in scarcity has to be deeply concerned about AI ripping them off. And our risk in that is effectively zero. That it's not replicatable, or even if someone tried to replicate it, it would be to our benefit. It's a very unique position to be in, and so I actually think that the AI, I would say maybe partially driven bear market, that capital rotation into AI stocks just doing so well, is ultimately something that's very bullish for what we're doing. And it's just like we're in such a unique position as an industry owning a bunch of Bitcoin that I couldn't be more excited for the future. And we'll ride this bear market out.
I love it, Matt. Never enough time to dig into everything, but I love where you left that. Certainly strive, and you were on the forefront of kind of helping put to bed a dominant ESG and lack of merit kind of narrative among corporations. And I hope they heed your advice again this time around and start stacking Bitcoin on their balance sheet. One thing we close off every episode with, Matt, if you'll say it, is stay orange.
Stay orange.
Love it. Give Matt a follow, Cole Macro on Twitter, Strive CEO. Ladies and gentlemen, Matt Cole.